Rolls-Royce, one of the United Kingdom's most iconic engineering firms, has confirmed the sale of its defined benefit pension scheme in a deal worth approximately £4.3 billion. The buyer is Pension Insurance Corporation, a specialist insurer focused on managing large retirement liabilities. The transaction covers the retirement security of around 36,000 individuals, including approximately 15,000 retirees currently receiving benefits and more than 21,000 deferred members who are entitled to future pensions. This bulk annuity deal, one of the largest of its kind in recent years, signifies not only a major financial transition for Rolls-Royce, but also reflects a growing trend among UK companies to offload long-term pension risks to the insurance sector. This sale removes a significant financial obligation from Rolls-Royce's balance sheet. For the company, the transfer is a strategic move that enhances its financial flexibility and helps it focus on core areas of innovation, particularly in aerospace and energy sectors. But beyond the corporate dimension, this transaction also reflects important shifts in the country's pension landscape changes that have implications for former employees, future retirees, and government policy alike. The transfer places full responsibility for pension delivery in the hands of Pension Insurance Corporation, a firm that is authorized and regulated by UK financial authorities. Retirees covered by the scheme will continue receiving the same payments as before, but their pensions will now be paid by the insurer rather than the employer. This change, while administratively seamless for most members, signals the steady decline of defined benefit schemes in the private sector. Decades ago, many large employers guaranteed a fixed pension based on years of service and final salary. Today, however, the costs and regulatory burdens associated with such schemes have led to a significant reduction in their use. According to recent government statistics, fewer than 1 in 5 private sector workers are now active members of a defined benefit scheme. As more companies pursue de-risking strategies, including buy-ins and full buyouts like this one, the insurance industry is playing a greater role in pension provision, raising questions about regulatory oversight, long-term solvency, and the shifting burden of retirement security. From the government's perspective, this transition intersects with broader policy challenges. In recent years, the Department for Work and Pensions has increasingly focused on ensuring that the state pension and public welfare systems can serve as a reliable foundation for all retirees, especially those without access to robust occupational schemes. This year, the full new state pension increased under the triple lock mechanism to approximately £230.25 per week. That brings the annual figure to nearly £11,973. For those receiving the older basic state pension, the weekly rate is now around £176.45. These increases are vital, especially for the growing number of pensioners who depend solely or primarily on public support in retirement. Pension credit, which offers additional support to those on low incomes, has also been adjusted. The minimum income guarantee now stands at around £227.10 per week for single pensioners, and around £346.60 for couples. The Department for Work and Pensions continues to urge eligible retirees to apply, as it is estimated that over 800,000 pensioners are entitled to pension credit but have not yet claimed it. Eligibility depends on total income and savings, but even modest additional income from pension credit can trigger other benefits such as housing support, council tax reduction, free TV licenses for over 75s, and access to cold weather payments in winter. Looking ahead, the government is also reviewing the state pension age. Currently set at 66, it is expected to rise gradually to 67 by the end of the decade, with further increases likely to follow depending on life expectancy data. These reviews are conducted in accordance with legislation that mandates periodic assessments. While no immediate changes have been announced for August 2025, the review process is ongoing and could influence retirement planning for millions in the years ahead. At the same time, the Chancellor and Treasury officials have been exploring ways to unlock pension fund capital to support domestic growth. Earlier this year, proposals were announced to encourage schemes with significant surpluses to invest more in UK infrastructure and startups. Initial estimates suggested that as much as £160 billion could be redirected toward national investment objectives. However, more recent projections indicate that only around £11 billion may actually be available for such deployment, as many schemes, like the one previously managed by Rolls-Royce, are choosing instead to use their surpluses to fund risk transfer deals with insurers. This has triggered renewed debate over the best use of pension assets, balancing the need for long-term security with the desire to stimulate economic growth. Meanwhile, Revenue and Customs has signaled potential tax implications for pensioners as the state pension continues to rise. With the full new state pension approaching the personal allowance threshold of approximately £12,570, many pensioners may find themselves subject to income tax, despite not having any other source of income. This could affect those with private pensions, part-time earnings, or dividend income, and might require more retirees to file tax returns or adjust their personal tax codes. As a result, financial advisors have urged pensioners to review their income profiles and seek guidance if they are unsure about their tax obligations. In the broader context of welfare, the Department for Work and Pensions has also implemented inflation-linked increases for working-age benefits, universal credit, employment support allowance, carers allowance, and other payments were uprated in April 2025 by approximately 1.7%. While this provides some relief to households dealing with persistent inflation, there are concerns that the uplift remains modest compared to actual rises in food, rent, and utility costs. The Household Support Fund remains active until March 2026, allowing local councils to provide emergency assistance for energy bills, essential items, and other living costs. However, funding allocations vary significantly by region, and citizens are encouraged to check with their local authority for eligibility criteria and application deadlines. In terms of benefit delivery, August 2025 includes an important payment schedule adjustment due to the summer bank holiday. Any DWP payments, including universal credit, state pension, child benefit, and other allowances due on Monday the 25th of August, will be paid early on Friday the 22nd of August. Claimants are advised to check their bank accounts and update their contact details with DWP to avoid disruptions. As always, missing or delayed payments can be reported via official helplines or the DWP's online portal, which is now equipped with enhanced user interfaces and updated security measures. For those navigating retirement or preparing to leave the workforce, this evolving landscape presents both opportunities and challenges. Deferring the state pension remains an option for those who wish to increase their weekly entitlement. For each year of deferral, the new state pension rises by approximately 5.8%. This can be a strategic choice for individuals who continue working or who have sufficient alternative income during the early years of retirement. However, the benefit of deferral depends on personal circumstances, life expectancy, and income needs, and should be considered carefully. The Rolls-Royce pension deal, while focused on a specific corporate scheme, is part of a much larger transformation underway in UK pension policy. It underscores the gradual withdrawal of employers from direct pension management and the growing reliance on insurance companies and state systems. For the affected retirees, this change means their pensions are now backed by an insurer with strict capital requirements and regulatory oversight. For the rest of the population, it is a reminder that the security of retirement relies increasingly on a mix of public provision, private savings, and strategic planning. Ultimately, the key message for UK residents is to remain alert, informed, and engaged. Whether relying on a defined benefit pension, the state pension, or a mix of income sources, it is essential to stay updated on changes from the Department for Work and Pensions, Revenue and Customs, and financial regulators. The policy landscape is shifting, but with the right tools and timely information, individuals can take control of their financial future and ensure that they receive what they are entitled to consistently, securely, and with clarity.